Welcome to Tech Talk Tuesday. There were some exciting things that happened in the stock market last week that we will talk about today. It's Tuesday, December 5th, 2023. My name is Carla, and with me today is your favorite CMT, David Blake. David, how are you doing this evening?
I'm doing well, Carla. Thank you.
Great. Well, let's jump right into it by taking a look at last week's stock market activity and what's ahead.
All right. Well, we had a fifth week of gains last week. Especially we started the week, kind of consolidating things, and then we had the Dow Jones went to a new 52-week high on Thursday, and then that was followed on Friday with the S&P 500 hitting a new 52-week high, which is basically we're getting this end of year rally again. It's gone on for 5 weeks. We had some dovish comments from Fed officials, and that pulled interest rates lower during the early part of the week. That added fuel to the fire that we're going to see an end of tightening, and they keep on talking still about hoping that there's going to be a rate cut in March, as early as March. I don't believe that will happen, but we'll have to see. And that's kind of getting investors a little excited to put more money into equities. Okay, we did see a little bit of softening in the labor market last week, and then we had the November PCE, which is personal consumption expenditures. That's the Federal Reserve's preferred inflation gauge, preferably the core specific. But that crossed the wires flat last week with the main PCE, and 3% year over year. I think core PCE was up about 0.2, which was pretty much in line, and about 3.4% year over year. So we're seeing the effect of the higher rates on inflation. It's coming down, and we'll get some more information on that this week, especially with the jobs market, which is the Fed's other focus right now. So we had yields come down to about a 4-month low as the period ended on Friday. That was part of that. Also was Fed Chair Jerome Powell. He did acknowledge progress on inflation, and he raised expectations that the Federal Reserve was finished with hiking rates, and that's what the market's been, especially the bulls, have been waiting on. They think as they start cutting rates, they will start to see a rally in the small caps, and we'll just see the market take off a little bit more. 10-year Treasury slipped to 4.218% on Friday, and it's actually lower than that today. We'll get into that here in just a little bit. We also saw crude oil prices end the week lower. Part of that is OPEC Plus announced a voluntary 2 million barrel a day production cut. But that was met with some skepticism because there's other producers now that are producing a lot of oil, including the United States, Venezuela, and some of the Nigeria, I think, and some of the African countries are saying, to heck with this. We're pumping out all we can right now, especially if the global economy is going to be slowing down with China and all with their problems. Okay, as far as the market sectors went, we talked recently that we've had 2 weeks where every sector was higher for the week. But we did see a little bit of a pullback this time in communication services. That was when weakness in Meta Platforms and Alphabet. So communication services pulled back. And then REITs, materials, industrials, and consumer discretionary and financial outperform. So you're seeing this rotation out of the big cap tech stocks, and Amazon usually is in with that XLY. But rotation out of there because of high valuations, and trying to pick up maybe some of the small caps, that type of thing. I think this year small caps are going to be down for a second year in a row, I believe, which rarely happens. So there are opportunities out there that some investors are seeing right now, that besides these, the Apples and the Microsoft and the Nvidia, there's some undervalued plays here in some of the secondary markets, which could be beneficial here in 2024 as you put money into the market. But anyway, as December kicked off on Friday, we had the Dow and the S&P and NASDAQ all off on a 5-week win streak, and that was their longest win streak since November of 2021. Okay, the technical condition of the market did improve again last week. It was kind of a sideways action for most of the week, but then on Thursday and Friday, we really started to take off again. We did see the Dow Jones; it blew through the summer highs. And it kind of is outperforming right now as we see this rotation more into the cyclicals and late cyclicals. And then we had the S&P 500 and NASDAQ kind of struggle with those summer highs. We'll see how that goes here. I mean, you don't anticipate a bearish or bullish pattern, but we are looking at the possibility if the market does start to pull back, that the S&P 500 and NASDAQ could be seeing a potential bearish double top chart pattern. We'll talk about that a little bit later, but that's just something to be aware of, that is a significant resistance point for the market. Okay, we had momentum on the Dow Jones, and S&P 500 remains strong. The NASDAQ momentum has slowed a little bit, and of course that's the rotation out of the big caps. And it's interesting to note, though, that the underlying breadth in the NASDAQ has been positive despite up until today has been positive despite the index itself drifting lower, and that's because the overweightedness of the big cap tech stocks and Amazon and stuff is where normally it might be down 30 points, it's going to be down 80 points because they have such a heavy weighting. And that's something to watch because, again, like yesterday, we had NASDAQ underperformed. It was lower, but underlying breadth was strong as we saw, people moving into the transports and the small caps. So that's something to be aware of. MACD, it's a short-term trend gauge. It's close to going into bearish territory for the NASDAQ. It may have done it already to start the week. And the Philadelphia Semiconductor Index also at an MACD bearish cross, so we want to be aware of that. A lot of times, and I mentioned it the last couple of weeks in the market letter, I look for some of this negative divergence in the weekly charts, and as it stands right now, I'm not really seeing that. In other words, with the negative divergence is where the market or indexes start to make new highs, but you start to see the indicators start to drift lower, and that's something that usually will be a hint that not all is right on the advance. So we'll keep an eye on that. But right now, you are seeing what basically the worst part of the thing of the market right now is the fact that we're seeing the big caps get rotated out of it into the smaller caps, which is actually a good thing for the market. That means we're broadening out and we're not going higher on the strength of 7 or 8 or 9 stocks. As it broadens out, I think we can see this market kind of maybe tick higher a little bit, or at least move sideways for a little bit. Did mention again that underlying breadth last week was positive. Investor sentiment, however, which is one of the indexes that we look at in the market letter, actually was negative. It's a -4. That means we're now starting to get excessively bullish. We saw that AAI, the American Association of Individual Investors, shows that retail bulls outnumber the bears 2.5 to 1. That's pretty. I think the last time I did that was back in 2020. I think I'm not sure, but anyway, that's it's just 6 years. Okay, that's the lowest percentage of bears in the survey in 6 years. Only 19.6% of retail investors are bearish, according to the AAII. Now, on the other side, you have the National Association of Active Investment Managers. Those are the hedge funds. Their exposure index climbed to 81.4. And that's the highest since July. So they've been steadily adding money to the market. I think just 4 or 5 weeks ago, they were down to about a 24.5% exposure to stocks. So they're coming in. So despite the fact that we're overbought in the market, it's not a reason to sell everything at this point. I think that we are seeing yesterday and today some churning and some consolidation of these 5 weeks of gains. The thing doesn't go straight up. And I think that, I wouldn't be real aggressive to buy the dips right in here for right now. Everyone's pretty excited about the end of the year rally, but just because you think it's a strong time for the market doesn't mean that you need to be running out and buying every dip that comes into the market here. We have a couple of things ahead of us right now that we need to watch. Tomorrow we have the ADP employment numbers coming in. That could surprise the market. Of course, today we saw JOLTS, which is job openings for November. It fell 6.6%. They were looking for 9.4 million job openings. It came in at only 8.7. So that's a much more of a drop than what analysts were looking for. And what you have to be careful about here is, you read about the Fed saying we want to see softer jobs data, that type of thing. There's a fine line there, and that you want to see it soften up, but you don't want to see it all of a sudden start to tumble, where you're starting to say, this soft landing picture is maybe a little bit too aggressive, and we may be going into a recession. And I think that kind of scared investors today. Again, we saw the JOLTS came in at 8.7 million versus expectations of 9.4, and we saw the rates drop all the way down to their lowest level, and I think since November of 2021, I think. The 10-year Treasury sank all the way down to 4.18, and the 2 years back to 4.5. On the 10-year, we were just looking at 5.25, 6 to 8 weeks ago. So that's a big drop in these yields, and it's something that normally you're saying, okay, we see drop in yields or rates, you're going to see stocks go higher. But today, and I know we mentioned this in last week's letter, you want to be careful about why the Fed would cut rates. Some people are saying, well, they're going to cut rates to, because we have a soft landing and we need to keep the economy going. But they could also be talking about lowering rates because the economy is getting ready to go into a recession, and that's the wrong reason that you want to see the Fed cutting rates. So with this week's inflation data, with tomorrow we have productivity and costs, and then the ADP reported on Friday. I think we get the Labor Department's jobs report, and they're probably going to be market movers. You don't want to be surprised. Too weak of a market. For a while back in the summer, bad news was good news. Well, now we're at the point where bad news is bad news. So if you come in, you've got a much weaker jobs report coming in from the government on Friday. That's not going to be good for the market. You'll see things sell off. You might see the rates maybe tick lower. And like I said today in today's comment, we kind of broke the trend today where yields go down and stocks go up. Today we had yields go down and we had stocks go down too, because the jobs number made everybody a little bit nervous. So right now, again, we're consolidating the gains from 5 weeks. We have slipped to a neutral on our market posture, and I think this week you're going to see more churning sideways probably with these reports before we can get a better picture of how the economy is handling the spike in rates earlier in the year. And I would say just stay on the sidelines maybe a little bit and hold on to what you have, and let's see how the market reacts to some of this week's economic data.
Okay, that actually brings up a question for me. You mentioned that we changed the market posture in the CTI, which is very important thing because that is our intermediate term forecast. So can the market still actually rally from here though, considering that it was just changed to a neutral and a -1 CTI?
Okay, yeah, the CTI again is a forecasting indicator. We look at this and we follow cycles that are in the market. First, found these cycles that went through the market. The 40-day and 80-day, 18-week, 36, 40-week, that type of thing. And our cyclical trend index it has rolled over. It's going into a negative configuration, which means we probably some of these cycles will start to bottom out here sometime right around the week or so right before Christmas, and then actually the longer term cycles will bottom out probably sometime in February. That's what we're forecasting right now. Now, again, the posture is neutral because there is an upward bias to the market at the end of the year. And in other words, historically, what causes that? It's not so much if you're not if you haven't been in the market a long time, you just hear about the end of year rally, the Santa rally. That means that the market always goes up. Well, there's a reason for that, and one of the reasons that they don't really talk about is because end of year bonuses, 401k contributions, those type of things come into to client investors, and the last for years, 20 years, whatever, it basically just rolled into the index funds, into stocks, into the stock market, because there really isn't any other alternative. You have the rates have been going low. They've been at zero for years. They were 1%, but this year, one of the first times in quite a while, you actually have some competition to stocks, and that is especially if you're an older near retiring, something like that. If you have a $50,000 bonus coming in, this year, instead of just going let's go ahead and buy me a couple index funds and throw it all in there, you may say, you know what, I can get 5%, 5.25%, to keep it safe. The market is a little bit overbought in here. I do have options that I can that I have instead of just throwing into stocks. And I think that's going to probably hinder how much this market rallies to the end of year. I mean, because I've said this earlier in the summer that it's going to be a little bit harder climb for this market when you have a competitor that's paying, say, hey, if you don't want any risk, I'll pay you 5.5% or whatever. Even if you go out into some of these prefers or something like that, you might be able to get 7.5%, 8%. And that market is probably not going to find its way back into stocks like it always has in the last several years. And so because of that, I don't think you're going to see, like, I see some of these guys on TV saying, hey, it's the end of the year, it's the end of the year rally, stocks always go up. We're at 40 45 67 today on the S&P. I got a 4,800 price target. I think that's a little bit, I think they're steering people the wrong way because of this competition between stocks and fixed income. I believe that this year, after the move that we've seen coming in here now, that we will probably see more churning, a little bit more up, down, choppy trading over the next couple of weeks. Again, I do think during our cycles, we should see a little bit of a weakness going into the last week or so of December. And I would not be buying the dips at this point. I'm not sure that I would just go sell everything by any means. But like today, yesterday the small caps were up about 1.5%, and today they were down about 1.5%. And the reason for that is small caps, if we go into a recession, they don't do so well. They do well when when the Fed's cutting rates, as the yields go lower, because then they'll take on more risk to their business, and that helps their business grow. And you'll see the small caps outperform. But if we go into a recession, you're not going to see the small caps outperform going to that time. Whether we do go into recession, that's still a coin flip. You have to watch the data. But I've been in this business 35 years, and generally when you see these interest rates go up and you see the yield curve invert, you do have a recession. I still think that it shouldn't be discounted completely. And if that is the case, where we start getting the economic data that does start to weaken, keeps getting weaker, and you start seeing Fed talk about maybe we'll cut rates, that's not going to drive the market higher like you think it's going to, because it will be cutting the rates because we're going into a slower economy, and that's not a real good for stocks at the early part of that. So yeah, the CTI is negative, our market posture is neutral. If we start to see some of these indexes start to break down through some key moving average support areas or Fibonacci retracement levels, then we could downgrade it to that's going to avoid. But for right now, we'll just stay neutral, which I think as of today, we're just down a little bit. I think it's mixed for the week. So at this point, we'll stay neutral and just see how some of this economic data comes out over the next week or two to see how negative we're going to get on the market.
Wow, that is a very interesting perspective, David, and it's good to take a look at the bigger picture. I guess I sort of answered my next question that I had for you, but normally I guess you would see with rates falling, then you would expect equities to continue to move higher. But then if you consider the whole picture and scope that you mentioned.
Exactly. If they're cutting rates because we're in trouble here. We raise them too fast, too high, too fast. We got to start cutting rates so the economy doesn't fall off the cliff here. That's then you no longer can watch the yield and say, oh great, they're going down, let's just buy stocks. That's not going to work any longer.
And the cool thing for me about technical analysis is also when you mention the cycle is, and you kind of get an idea of, obviously, it's technical analysis, anything can happen in the world, but you kind of get an idea. You mentioned the last week of the year, probably tapering off a bit, and then this cycle is expected to last until about February. So that is definitely a cool thing for me, and you kind of get a longer term perspective of kind of what to expect.
Well, it's again, it's a forecasting model, and I guess it's just like you get a forecasting model on a football game, and it could be right. They could play the scenario out and be right 50% of the time or 75% of the time, and the team that they like still loses the game. So the cycles are, it's not trend following, which is what second opinion is. With second opinion, when the things going up, we're going to be long. But when you forecast something going out like that, there's a lot of side reports that come in, and we constantly are looking at the cycles and the market highs and lows to see where the troughs are, where the peaks are, to see, to make sure and adjust to say, okay, this wasn't the bottom. The bottom was actually 2 weeks ago, so we need to move this cycle back a little bit, and then it becomes more of an art form. But it does have, I think it's at some points back in the early 2000s, we'd outperformed the Dow Jones about 2 to 1 almost, with the way our cycles had gone. So there is some merit to it. Hearst 50 years ago found these cycles and has a lot of work on it, and we've Tom Ventresca here, who started our company, he's followed that on. I've done a lot of work on them too, and I think that at this stage we'll watch to see how this goes. This has been a very, very difficult market for cycles and all that, because even over the last several years, when because part of these cycles are based around the business cycle, and back there in the early 2000s, the government basically eliminated business cycles because they said, okay, we just got to prop up stuff if instead of just having things go up and then come, then raise rates to slow it down, then cut rates to build it back up again. They just kept cutting rates and trying to keep it propped up forever, rather than letting the business cycle slow down. And that really threw a wrench into the market, and has caused several bubbles over the last several years.
Well, I do love the sports reference, and people tend to put money where their mouth is and also in what they feel is going to happen. So, a lot of wonderful information this week. Is there anything that you'd like to quickly add before we wrap this week up?
No, I think we're good. Let's see what happens here over the next couple of days. Again, tomorrow the ADP employment report will be important, but the big one is going to be the Labor Department's report on Friday morning. Let's just see how that goes, and if it's too strong, that could get people talking about, do we need to keep rates higher for longer? If it's too weak, then they may start talking about cutting rates because we're going to recession. So I would just be I'd stay on the sidelines here for the rest of the week and just see what happens. You've had 5 weeks of gains, so it's not like you got to jump in here right now because you're missing. You kind of already have missed a lot of it. So just watch what happens here, and we'll see how these reports come in, and that will basically dictate whether we can see the market nudge higher a little bit here, or whether we've kind of seen things and we're going to start to drift lower into the year, and Santa ends up being a no-show.
Oh, hopefully we get to see Santa this year. Fingers crossed. And I think that gives us a pretty good podcast for this week. So, David, thank you as always for all the great information. And you guys can catch us again next week.
All right, Carla, goodbye.